Atkor is a simple, boring company that makes millions by creating products that help organize and protect wires, cables, and pipes. So let's try to understand why its stock dropped 67% since March 2024 despite a high demand for their products. And to do that, we will go through our 7-step analysis process. We will look at the financial situation of the company, its growth, dividends, and all that good stuff. And finally, we will value it to see, is it an interesting investment opportunity? But first, let's take a look at Atkor's recent financial results. Revenue is down by 9% year over year. Net income is down by 31.5%, cash is down by 9.5%, and debt is up by 0.3%. So the short-term results are not looking great, and after publishing such results, the stock went down by over 22% in one day. But let's look at the company, let's look at the fundamentals to see how strong this business really is. Because sometimes short-term results, cyclicality, investor sentiment may create incredible investment opportunities. So let's take a closer look at it. If you invested $1,000 in this company 10 years ago, you bought 63 shares. And today, they would be worth something close to $3,928. And this company also pays dividends, so in that time you would get $60 as dividends. So if we add together the current value of shares and the dividends, we get $3,988. So after the recent incredible drop, it is still a gain of 298% in 10 years. That is a good result, especially for a company that specializes in something as exciting as cable management. So let's see who owns this company. Individual insiders, that is an X, 0.9% of the company is owned by individual insiders. And we would like to see this number over 2%, so it's not quite there. And are individual insiders buying? That is also an X. We actually see a lot of sale transactions in the recent quarters. And do super investors own this company? That is an X. Lee Ainsley buys and sells this company on a regular basis since 2018. But last quarter, he sold it again. So, of course, super investors are not buying this stock recently. It looks like insiders and super investors agree with the market and are avoiding this stock in the recent quarters. But let's take a look at the company itself. Return on invested capital, that is a check at 13.6% 10-year median returns. And we want to see this number higher than 10%, so a nice result. And what about net profit margin? It is a check averaging 17.3% over 5 years. And the sector median is just 6.5%. So that shows some real pricing power. And now let's take a look at share buyback. It is a huge check. In the last 10 years, they bought back 43% of shares. That is great news for long-term investors. If there are less shares available, every share is worth more. And during the recent earnings call, they also revealed that they plan to spend another $50 million on the repurchasing program. So that is very nice. And the debt, it is a check. It would take just under 2 years to pay the long-term debt with a current free cash flow. So they made it. We have checks all around. That is a very good sign. But financial health is not the only thing we should concentrate on. There is also growth. Revenue growth, that is an X at 6.5% 10-year compound annual growth rate. And we would like to see this number higher than 10%, so that is a bit disappointing. Free cash flow growth, that is a check at 19.2% in the last 10 years. So that, on the other hand, is very impressive. And earnings per share growth, that is a check at 38% growth since 2016. Unfortunately, it is impossible to calculate that 10-year growth rate because before 2016 they were losing money. So overall, some nice growth, but we have to take into consideration that it is a cyclical industry. Its results are influenced by the overall situation in the economy, and with such companies, growth metrics can be sometimes misleading. And what do we know about dividends? The dividend yield is at 2%, so shareholders can expect to get $1.28 annually per every share. And the payout ratio, that is an X at 8%. And we want to see the payout ratio somewhere between 20 and 50%. So it is a safe but rather low dividend. And what about dividend growth? That is an X. They just started to pay dividends in 2024, so we just don't have any data to work with. What we do know after the earnings call is that they intend to distribute $11 million to shareholders as dividends in the next quarter. And now it's time to value Atkore and see, can it be a good investment? Price to earnings ratio is just 6, so that is very low. No wonder we can find this company on the magic formula list. But PE ratio can be sometimes misleading, so to calculate the intrinsic value of this company, we will use a discounted cash flow analysis. And if you're interested in learning how to value companies on your own using 4 most commonly used models, head over to stockinvesting.academy and check out our company valuation course. Okay, so first we have to estimate the growth of Atkore. So in the low scenario, we will estimate a growth of 1% for the first 5 years and then 2%. In the medium, 2% and then 4%, and in the high scenario, 4% and then 6% growth. So we want to be conservative in our estimates, and so the low scenario is close to the lowest growth prediction for the industry I could find. Medium is anticipating that this company will outperform its peers, and the high one is showing a story in which Atkore will continue to grow at a similar pace it did in the recent decade. So with such estimates, the intrinsic value in the low scenario is $128, in the medium $143, and in the high scenario $167. But we have to always apply a margin of safety to those prices. I use a 30% one. And with such a margin, we get in the low scenario $89, in the medium $100, and in the high one $117. And the current price is around $62. So it is all in the green. Atkore looks really nicely priced at the moment. But we are not quite finished. We should zoom out, look at the big picture, and try to understand why its stock went down so much in the recent year. So this is definitely a cheap company that has a good financial health and a decent growth. But Atkore's business depends on prices of materials such as steel. And since these prices dropped, Atkore had to lower its selling prices too. Average selling price was down by 16.5% in 2023 and then by 11.5% in 2024. And because of that, operating income dropped from $1.2 billion in 2022 to just $0.6 billion in 2024. Another problem, besides raw material prices, is the growing competition, especially from low-quality steel and PVC imports. So it looks like they are doing really badly. But actually, sales volume in 2023 went up by 3.2%, and in 2024, it was up by 3.5%. So yes, they are making less money, but their business is actually growing nicely all the time. Even the recent results show only a 5% decline in sales volume. Does it really justify a 22% drop in one day? Well, I don't know. If we open our Stock Ranking Pro, which you can get access to by becoming a patron, we see that Atkore is an 11th cheapest company in the stock ranking. And when we open the overview, we can see that investor sentiment and dividends are nothing exceptional, but financial health and growth are really nice. So it's pretty obvious that Atkore will face some challenging quarters ahead and the stock may continue to decline. However, the fundamentals of the business haven't changed as much as the stock price, and that may create a very interesting investment opportunity.